Hello and welcome to Ingenomics. My guest today is someone who has been on the forefront of bearing the brunt of a slowing global economy and an Indian economy which is still trying to find green shoots. My guest is the Managing Director and CEO of Axis Bank, Shikha Sharma. Shikha, thank you very much for joining me.
Thank you, Latha.
Well, first up, some questions on your P&L. You said that your fresh slippages were 2,082 crores. Your strategic debt restructuring was 500 crore and 1,600 crores of loans given, the 525 refinancing. Would it be fair to say, therefore, that otherwise your slippages would have been 4,000 crore this quarter?
So, Latha, just as earlier we've talked about this whole issue of NPA and restructured, and try to clarify that restructured is not equal to NPA, because restructured is typically when you want to give accommodation to a company where there's a cash flow mismatch and you hope that they will come out of it. And all the historical evidence is that about 25% of restructured has slipped into NPA. I would argue that similarly, SDR and 525 should not be looked at as NPA. SDR, of course, is happening in companies which are stressed, and therefore we need to convert it to equity to be able to do more active stuff. But 525 really is a case of mismatch in financing structure. So I wouldn't put 525 in the bucket of stress.
The analyst community has repeatedly looked at some part of the 525 as stress assets because many of these companies, the interest cover is less than 1 for the past many quarters, some 4, some 8, some 12. So would it be legitimate to say that a third of that or a quarter of that also may slip?
That's not our understanding as of now. So it's a little early to figure this out, but we are looking at the data to try and see what the slippage could be. But our understanding is not that it's going to be around 20. On SDR, we do think the slippage could be higher, but not on 525.
Have you also provided for the SDR, since you said that there is a chance of strategic debt revamp cases going bad?
No, we haven't, because that doesn't come into the NPA category, but our contingent provisions would actually work across this pool of assets, whether it's SDR or any other asset where we think there could be potential stress.
You have said in the past that your total exposure to the highly indebted group has come down from 12 to 8%.
That's right.
Does it still remain at 8%?
Approximately, yes.
Okay. So 8% of your total book would be around 24,000 crores.
Right.
How much do you think more stress can come over the next 1 year? 1.68 now. Should one be prepared for 2?
So, Latha, we actually do this whole exercise of looking at the book towards the end of the financial year and try and give a guidance number of what the numbers could be like for the next year. Frankly, we haven't completed that exercise, so I would hesitate to give a guidance number for the next financial year just yet. But all I can say is that the economy is what it is, and it is improving only slowly. And of course, we have seen some global shock coming from the slowdown in China. So there could be some stresses coming from the system. As I said, we will come and try and give guidance to it early next year.
But, the analyst community, the investor community does discount the price 1 year forward. There are people who are looking at a 2.4% as the maximum by FY18 when the stress is recognized. That is their base case. It's not their bear case. Do you think they are on the ball?
I will still say, hold it. We will come back with a guidance number next financial year. But you've seen our numbers, despite the fears around the whole asset quality review and what impact it would have on banks. You've seen what it has meant. Yes, there has been a higher slippage than has been normal, but it's not been anything very dramatic. And while the regulator did give us dispensation to do this by March 16, we've actually taken it all in this quarter. So there's no surprises coming from the AQR stuff next quarter.
That's very positive. But you normally give us a guidance in terms of stress for the full year, and you had originally given us that 6,000 crore. Would you want to revise that number for the last quarter?
I think for the next quarter, it could be another 1,000-1,200 crores. But for the full year of next year, we'll come back with numbers early in the financial year.
Okay. So what would this do to credit costs? Should we say it would be 90 basis points?
So Latha, kind of depends upon the definition that we want to use. And if we use the definition that we want to look at everything that we dipped into contingent, then the number could be different. So if we just look at without the dip into contingent, it's probably about 90, around the 90. But if we look at the dip into contingent, then it would be a higher number, probably about 120 to 130.
Okay. Would that be about the worst, or do you think next year we should be prepared for a slightly higher credit cost?
I would be surprised if it's higher, but as I said, please wait for us to come back on that specific stuff early next year.
Okay, fair enough. I completely agree it's an evolving situation, and we are in the midst of some manic selling of commodities. But let me come to how you are trying to build moats around your own balance sheet. You have increased your retail portfolio. What does it stand at now?
Retail is about 40% of total portfolio now, so it's actually grown pretty well.
And where do you see it going by next year? What are your self-given targets?
So, it kind of depends on what growth opportunities there are outside of retail. Retail is growing healthily at 27%, and we would hope that will continue to grow at a 25% kind of number. But in the last few quarters, we have seen opportunities in corporate credit growth coming from refinancing opportunities for projects which have got completed. So we're not actually targeting a mix anymore. It was important for us as a strategic imperative to have a more balanced book when we started out the whole journey of trying to balance out the book in 2009, and that's when we had said we wanted to increase the proportion of retail. At 40 retail, another 15 SME, we have a reasonable balance in the book. So we just look at where growth opportunities come. I would think that retail should continue to grow as a proportion of the book, but I couldn't give you a specific number.
Okay, well, what is the regulator's advice for next year? Have they given you any broad guidelines in terms of recognizing emerging stress?
No, not
because
really.
The RBI keeps on talking about March 2017.
Yeah.
So have they given you any guidance of how much you will have to recognize?
So I think RBI spoke to some of the media, and I think media has written up a whole lot about the Annex 1, Annex 2, Annex 3, the three lists that RBI has. The first around looking at accounts which may not be 90 DPD but have shown frequent delays in payment. Then those where there could be a delay in commencement of commercial production, which they have guided banks to say that maybe you need to recognize that as NPA. And then there's another list of restructured cases which they feel may not go well, and they're asking banks to start to provision for that and saying that if you don't see positive signals on these, then by 2017 you have to recognize it as NPA, which is legitimate.
Okay. Well, let me ask you very directly. Are you exposed to stocks, to accounts like, say, SRC? This is, a repeat defaulter. Yeah. Are you exposed to that? And therefore, will you rethink the 525 for that company?
So, as you know, Latha, we can't talk specific names and specific cases, and we've never done that in the past. But, we will look at what needs to be done based on the stresses that are emerging in the system, and look at either strengthening the balance sheet or seeing whatever needs to be done.
But is it that the regulator is even asking you whether the cases that have been given 525 ought to be reconsidered?
We are not aware of any such conversation.
Okay. Is there any, self-regulation or, advised by the regulator that plants which were, given, say, a 40,000 crore assessment in 2008 should now be written down because, steel prices what they are and possible over-invoicing in those times? Have they asked banks to write down certain loans simply because they are not worth the number that was put up in 2008?
I think what would be prudent for banks to do is to look at these assets and try and see if there is any need for creating some kind of floating provision around that. And
you are doing that?
So, we've been doing the contingent provisions, which were intended towards companies that we saw incipient stress coming through. And there may have been certain kinds of companies in the past. There could be others in the future.
Just a few more questions on the P&L, actually, very brief ones. Do you see scope of further base rate cuts in the next quarter or so?
Yes, as the benefit of cost of funds flows through, there could be reducing base rates out in the future. I don't think anything dramatic because of the net 100 basis point cut through repo. We've already passed through 70. So there is a little bit of a residue left there, but there's not a lot. We'll have to see how much time it takes.
No, the new MCLR kicks in, marginal costing. So because of that, will new loans be cheaper? If yes, how much? Like 10 basis, 15 basis, 20, 25?
That's what I'm saying. That, even if we looked at the average cost system, then there's just a residue of about 30 basis points left. So that kind of provides a cap to how much rates could go down. But it will depend upon what the markets are like, because on a marginal we have to look at what the liquidity situation is at that point of time, and therefore what happens to rates in general.
So therefore margins. There is obviously that trimming of margins in the third quarter because the base rates came down. How much should we be prepared for in the fourth quarter? Another 10 basis?
Latha, so our margins come down a little bit because we leverage up the capital, and we've always indicated that you lose a bit of margin because we have excess capital, and as that gets levered up, that comes down. The whole base rate has also meant some reduction in margins, but not a lot. So, and product mix changes also have an impact on margin. So net, we don't expect a big drop in margins from here, but there could be a 5 to 10 basis points.
And finally, loan growth number.
Loan growth, again, it's linked to what we see in the economy, but we would expect that, given our size, we're still only about 3.5–4% market share, we should be able to grow it maybe around 18–20%.
All right. Shikha,
led primarily by retail.
Okay, we have to take a break on that note. But thereafter, we have to ask Shikha Sharma the more longer term questions. There are 21 banks with licenses. How does that change the terrain for the incumbents? All those questions in a minute.